The strengthening US dollar and its impact on the Japanese yen. In March 2024, the Bank of Japan made a significant move by raising its benchmark interest rate for the first time in 17 years. This marked the end of a long-standing policy of negative interest rates aimed at stimulating the economy. The overnight lending rate for banks was increased to a range of 0 to 0.1%, signaling a departure from the ultra-loose monetary policy in place since February 2007. The negative interest rate policy, along with other measures, was intended to combat deflationary pressures by injecting money into the economy and keeping borrowing costs low. Recently, the US dollar has achieved unprecedented strength against the Japanese yen, reaching levels not seen since the 1980s. This significant currency shift has profound economic implications for Japan, raising concerns and potential responses from policymakers. Historical context and current trends. The strengthening of the US dollar can be attributed to robust economic performance in the United States, rising interest rates, and geopolitical stability that boosts investor confidence. In contrast, the Japanese yen has remained weak due to Japan's prolonged low interest rate policies and a slower economic recovery post-pandemic. Economic consequences for Japan. Increased import costs. A weaker yen increases the cost of imported goods and services. Given Japan's reliance on imports for raw materials, energy, and various consumer goods, this devaluation directly raises costs for businesses and consumers. Inflationary pressures. As import costs rise, businesses may pass these increased costs on to consumers, leading to inflation. For Japan, which has struggled with deflation for years, a sudden shift to inflation could present new challenges. Impact on exports. While a weaker yen can make Japanese exports more competitive globally, the benefit may be offset by higher costs of imported materials used in manufacturing these exports. Additionally, prolonged yen weakness could erode profit margins for Japanese companies. Potential policy responses. To mitigate the economic consequences of a weakening yen, Japanese policymakers have several strategies. Monetary policy adjustments. The Bank of Japan could consider revising its long-standing low interest rate policy. While this could attract foreign investment and strengthen the yen, it must be balanced against potential impacts on domestic borrowing costs and economic growth. Foreign exchange interventions. The Japanese government might engage in direct market interventions to stabilize the yen by buying yen and selling foreign currencies. However, these interventions are costly and difficult to sustain over the long term. Economic stimulus measures. Implementing targeted economic stimulus measures to bolster domestic economic activity could help. These might include fiscal policies such as tax cuts, increased public spending, or incentives for business investments. The evolving exchange rate between the US dollar and the Japanese yen is a critical issue with far-reaching implications for Japan's economy. As the yen continues to show weakness, it is imperative for Japanese policymakers to act decisively to address these economic challenges and ensure stability. In this dynamic global economic landscape, the actions taken today will shape the economic realities of tomorrow. Close monitoring and strategic responses will be essential in navigating this period of currency fluctuation and maintaining economic resilience.